Okay. Okay, so welcome everyone. And just to, you know, go through this again, the strategy is called my pay packet. My pay packet strategy is one of the very first, strategies that I started, well, one of the strategies I started using, but obviously with time, you kind of like drift into other strategies and techniques as well. But this one is very, simple and straightforward. I have enhanced it anyhow, since I started using it, over a decade ago, So obviously the way I trade it now is a lot simpler and, you know, um, easy to learn. So it's called my pay packet strategy, oth- otherwise known as MPP. You require three moving averages for this. I always say, do not let anybody, knock you or tease you, taunt you for using indicators. You know, um, if it works for you, all we want to do at the end of the day is make profit, is be profitable in the market, make money. So however which way you do it. I also trade price action. When I say I drifted away from this, strategy, is because I learned a lot more about price action. Because when I learned using indicators, and the moving average was one of them. Okay, so I do, if you like, you can come. Well, this strategy actually is a combination of both price action and the use of indicators. Indicators obviously, just give you confluence. Okay, so these are the moving averages you would need. The 8 SMA, 20, and the 200 SMA. Okay, so what we're going to be looking to do is to basically, look for impulse moves in the market. We look for impulse move in the market whereby, either it shoots up or down. In this case, it shoots up, there's a correction, and it continues. I mean, this works very well. It works very profitably. So, you could otherwise call it ICC, you know, impulse, correction, continuation. Okay, so let's go to the chart. You know, I know the popular. This is what's it called? This is a trading view, but one of the um, one of the platforms that traders tend to use is the MT4 or the MT5. So we are going to be switching to the MT4, which is pretty similar to the MT5, and we will take it from there. Okay, let's switch. Okay, so this is Nasdaq. We might as well start here. We might as well start here on Nasdaq. Since it's one of the trades that some of us do trade. So um, now for those who I can see, some of you are beginning to join in. For those who were here yesterday, I might obviously, like it is when you teach one day and you teach the next day, depending on the questions that are asked, or depending on the flow, there could be some new things added to what was taught yesterday. So you might actually pick up one or two new things. So as we were saying a while ago, as we're seeing on the Telegram, the red is the 200 SMA. The red is the 200. The purple is the 20, and this is the 10. Now, these are the ones I have chosen. I mean, I have used various moving averages in my own time, but, really, a lot of them do work. You just want a crossover. You want the moving average to cross over to give you an idea of where the price is going. Now, you can see here on NASDAQ, this happens to be the 15-minute. Like I say, it works on all time frames. When the bigger of all the moving averages here, as in the 200 is below, and you have the next one, the 20, then the 10, it basically the moving average telling you or confirming that it's an uptrend. when it's the other way around, when it's the other way around, like so, the 200 on top, well, okay, it's not too, okay, this is better. The 200 on top, followed by the 20 and the 10, it tells you is going down. So if you like, this is big, bigger, biggest, the 200 being the biggest or the heaviest, the heaviest of the three. So big, bigger, biggest, it's going down. If it's flipped the other way around, then it means it's going up. So what we actually do want, or what I would actually, so what we're actually wanting is for the 10 to cross over the 20. In this case, it's crossing it to the downside, so we're looking to sell. You know, now there are going to be times when, even though it's the way it is, you buy, but it could be that you're counter trend trading. What I do advise, especially if you are going to be trading this, if you're going to be using to trade a prop firm, or you are in a situation whereby you really want your win rate to increase, I would say stick very closely to stick very closely following the trend direction as the moving averages tell you. So don't, when it's arranged like this with the heavier one on top, don't be looking to buy unless you have some price action technique or something, don't do all that. Just stick to the direction of the moving averages, or what the moving averages is signaling to you, and stick to that. And believe me, that will be the easier trades you'll be taking. It will be what do you call it now? It will be low hanging fruits. Where you are most likely going to win. So when it comes to this strategy, what you want to do is to buy preferably when there is a continuation. Remember a while ago, I did say, that it's impulse move, correction, continuation. An impulse move is something like this, when the price pushes powerfully in one direction. In this case, it happens to be to the downside. Other times, it could be to the upside. But the impulse is this move down, all the way down. Let me Okay, I suppose this is better. So we see here the price pushes down and then it goes up in a correction and continues. We know that's how the market basically moves: impulse, correction, continuation. So the ICC, impulse, correction, continuation. So what we preferably want to do is to join the trade when it's continuing. When the, oops, sorry about that. Let me go back. I think I just, okay, I mistakenly came out of my screen share, I think. Okay, so what we basically, want is a situation whereby we join the market when it is continuing. So let's do this. Let's go back here. So we can see here, for instance, the moving averages are lined up the way we want it. We can see this is basically where the 10 crossed the 20. So to make it, stand out visually, you want to mark it there so okay, fine. Anywhere after that, anywhere to the right side of this line is where I'm going to be looking to join the trade. So there has been a cross, there's a move down now. What you want to do is you don't have to see a big correction like we saw a while ago, whereby there's a big move. I mean, like this, whereby there's a big move before you join. No, it doesn't have to be a big move. When we talk of correction, we're talking of a pullback or a retracement, yes. But guess what? You can also join the trade when there is just one candle pause. So there was this push down by these two red candles, and then it moved up with the opposite color. Call it a pullback, call it some kind of correction. Not so much correction, but I would call it a pause. If it had gone up a bit more, maybe about 3 green candles, I would have said, okay, fine, that's a correction. But as it is just one candle, I would call it a pause. Okay, fine. You could call this a small pullback because there are 3 green candles, but it's because, they are kind of like, this is longish and the other ones are small. It's more or less a pause. But guess what? Whether it's a pause or a correction, you can trade it. You can join the trade when it's continuing. So because you are selling, you want to be joining really when the candle is red. Now, some people would join it when the price goes close to, I want to join when the price goes close to the 10 or even the 20. But I would say the real confirmation is when, there's a red candle showing that the bears are now in control. They've regained control. So in this case, I would enter this trade here. That could be one of the places I enter because, mind you, the crossover happened here. You want it to be that, the crossover has happened and you can actually see a space between the two moving averages. In the sense, it's not going up and down it. They are both, the two moving averages are now beginning to point down. They are now descending. So some people might wait until it's very obvious that they are descending and hence want to enter here. But really, you could have been able to enter here as well. Now, this yellow dotted line is my entry point, if you like. So really, you could have been able to enter here because even just going back, you can see the price looking left, the price has been going down, correction and going down. And because the 200 is above, it means it's a long-term downtrend. So when the cross happens here, and it begins to go down just slightly, especially with this big push, this is a momentum candle, especially with this big push down, it's telling you the bears are in control. I like to believe we all know what bears are. We talk of bulls and bears in the market. The bulls being the ones that take the price up and the bears take it down. Because of this strong bearish candle, you can tell the bears are in control and you could have been able to enter here. And the beauty of this is that it's a one candle stop loss trade. One candle or maximum 2 stop losses, and that is it. So this is my stop loss. I'll just place it, think of these 2 candles. I'll place it, just there so that even if the market pulls back and goes hit my stop loss, it's going to take out just that 1 candle. But guess what? Like I say, this strategy would increase your profitability greatly. You can even do it on your phone, because you have a 1 or maximum 2 candle stop loss, but look at the potential number of pips or candles you will capture. There are a number of ways you can decide to stay in this trade. You can decide to stay in this trade, just capturing a few pips well, not a few pips. You don't want to, I mean, if there's a potential to give you a few, more than a few pips, you don't want to be capturing a few pips. You don't want to be leaving anything on the table. You know what I mean is, if you don't have the time, you know, you just basically want to get some pips, not a few, but some pips, and be out of the market, then fine. You could measure the range of that candle, because this is the entry. Measure the range of that candle and go for ×2, ×3, and you are done. Like I say, maybe because you don't have time, you know, to be watching or monitoring the chart, just go for, you know, 2R. That would be 2R. That would be like 2R, isn't it? From here to the stop loss, you know what? Let's just make it a round number so that we can, you know, calculate it better. Let's just call it 10. From here to here, you know, let's just call it, you know, like in about 1,000 or so. Let's just call it about 1,000. You know, you go for 3. That's like you know, so what you basically want to do is just go for maybe 1 to 2, 1 to 3, or if you want to stay in the trade, if you want to get the most out of the trade, you could then decide, I will stay in this trade until it goes and closes above the 10 SMA. On this occasion, it closed above it, you know, so as not to take any risk, even though it closed above it and then continued anyway, but so as not to take any risk. I would say once it closes there, you could decide to come out, unless maybe you have moved your stop loss, you know, here, just to see, okay, I mean, after all, you've gained all this much, you know, so you've placed the stop loss there just in case it doesn't get there. And on this occasion, it did not. It just continued down. You know, what you are now doing is you are trailing you are trailing your stops, your stop. You just keep on trailing it. That's if you have time anyway. If you're able to, you know, if you have the time to do that manually, you can be trailing it. And guess what? Anyway, I mean, obviously this went into the next day. I mean, you entered on the 19th of August, you know, and it went into the next day. But assuming it happened in one day, you can stay with it and just trail it as much as you want. So one, the beauty of this strategy, I mean, we're going to look at some more things as it relates to this strategy. But one of the beauties of this strategy is a 1 or maximum 2 candle stop loss. And you can see this big candle engulfed the previous one. So in a sense, it's a 1 candle stop loss really. But other examples I'm going to show you where it's going to be like 2 candle stop loss, you know, you will see. So what I'm saying is one of the benefits, the super benefit with this one is that you lose just 1 candle if you do lose, but you potentially capture this. So think of it this way. Think of it going forward that each time you enter a trade, you're going to lose a maximum of 1 or 2, or maybe 1.5. But you're going to be capturing multiple candles. People talk of, oh, I want to have a high win rate, which basically means you want to be winning a whole lot more times than you lose. Okay, that is good, but it's also equally good, if not better, for your risk to reward to be high. Losing 1 to potentially gain 3, 4, or 5. That is awesome. That is awesome. You know, so that's the major benefit. And with this, you don't have to, you don't second guess yourself. That's why I say it's so easy. You can trade it on the phone. You don't have to do any heavy analysis. What you just want is for the moving averages to be arranged like this. So think of the criteria. 1, you want the moving averages to be arranged in this order. If you are selling, the 200 on top, followed by the 20, and then the 10. Now, there are going to be times when it crosses above like that. You don't want to be buying. You don't want to be buying on a pullback. You want to be buying on a continuation. So when it goes up like that, when the price goes up like that, you know when price goes up, because price is king, you know, those who trade price action, price is king. You know, when price goes up like that, the moving average will follow. So you want to wait for price to come back down and the moving average cross again a second time. You know, because think of it this way. If you think of it this way, all this time, you know, all this time, the 200 remained on top, but the 10 and the 20 were just, you know, well, the 10 was crossing up and down the 20. The 10 was just crossing up and down the 20. Each time you want to enter is when it crosses back down if you are selling. Now, guess what? If you understand price action, because price is here and the candle is, the 200 is far away, yes, you could do a quick counter trend trade, but I would say don't do that if you do not understand how to trade price action. Ah, yes, 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 yes. It's a serious advice. Don't counter trend trade. I mean, I used to counter trend trade. I still counter trend trade. Well, okay, not counter trend trade as such, but when the price is going to reverse, that's when I do take trades when I know the price or I believe the price is going to reverse. On this occasion, I would not be looking to buy because I can tell it's a strong downward push. It's not going to be reversing anytime soon, at least in this area. So I will not so much be looking to counter trend. If I do, obviously it's just a scalp because you can only get so much pips if you're counter trend trading. But if you're going with the trend, you're going to catch more. So like I say, only look to enter if the price goes up like that. Because the 200 is there, don't enter. Just wait for the easy pickings. Wait for price to come back down again. See, you could have entered here when the price, I mean, the the cross happened here. That's the moving average crossed each other down here. You want to wait for price to go up a bit. I mean, in this case, it didn't go up. It was just kind of like oscillating there. But you want it to be that it goes above or near the 10 or even the 20. And when the price now shows sign of continuing, you can jump in. You can jump in for a sell here. I mean, yes, even this, I'm sure you got 1-to-1 because you would have placed your stop loss just there. Like I say, it's a 1 or 2 candle stop loss. Let me make this bigger. Is it this one? Yeah, it's a 1 or 2 candle stop loss. You enter here at the close of this candle. Like also note, you are to enter at the close of the candle. Try not to enter when the candle is not closed because there are times when it's dropping, dropping, dropping. You jump in thinking it's going to continue and it just goes up and closes up. So when this candle closed, you enter. But guess what? Because this candle is here, this is not, it's no longer a 1 candle stop loss, it's a 2 candle stop loss because the previous candle which was taken out is higher, but it's only just slightly higher. But anyway, we nevertheless count it as a 2 candle stop. Count as a 2 candle stop loss. You know, are we going to get a 1-to-1? Let's see if we get a 1-to-1. Okay, that's about 335. Okay, fine. We didn't quite get a 1-to-1 here, but guess what? You know, if it so happened that you stayed in this trade, okay, fine, you would have lost it. But guess what? We don't win every trade, and we don't even expect to win every trade. There are going to be some trades you lose. Now, I know some people are going to want to play clever, whereby they enter this trade, and when it goes down, you know, we are happy, we are clapping and everything. But as it begins to push up, you quickly bring your stop loss to break even. No, you don't want to do that. Give the market room to breathe. You know, like I've been saying, when you lose, you're going to be losing just one. And because the win rate is high, you're looking at an over 80% win rate. Now, guess what? Even if the win rate is 60% on this, because majority of the trades are going to be you winning or winning 1 to 3, 1 to 2, 1 to 3, 1 to 4, it's going to all balance out and leave you in some big profits still. So don't try and be getting clever and quickly moving things to break even just because you see the price. Let it either go hit your TP or hit the stop loss. Seriously. I mean, this one, you lost the 2 candle. I mean, this is like 1 1/4 candle, but fine, let's call it 2 candle. You lost this one, but guess what? You know, you know very well, that you can get in the trade again. You can always get in the trade. Let's take it back there. Oops. So it went up and hit your stop loss was here. It went up and hit your stop loss. And guess what? It came down again. Now, something else, that is worth noting. The best time to enter this trade is when all moving averages are near each other like this. So in a sense, the price has just left a key level. If you like, the boss or the coach has just left the station. That's the best time to enter. So one, it doesn't mean you cannot enter. I mean, if you had entered, here, I mean, it doesn't mean you have to have entered there. That was the crossover there. It doesn't mean I mean, if it doesn't mean if you don't enter here, you don't enter, you've missed it. No, you can still enter after the price has moved, but just know that you're going to be getting less, then. I mean, after all, this trade just continued. Come on. It just continued into the next day. So even if you didn't catch it at the very outset, you could have still caught it here. Just wait for a pullback. In this case, there was a pullback, a little pullback there. You are waiting for a color change. That's when the bears take over again. You enter. That's the color change. Color change from green to red. Or if you like, power change hands between, from the bulls to the bears. So it pushed up. You are waiting for this candle to be taken out. Not this one necessarily. When it pushes, even if it are pushed all the way up, the first green candle that is taken out, you jump in. So this one, for instance, is the one you want to jump in at. When this candle is taken out, that's the body and the wick. This one did not take it out. This one took it out because it closed below it. So you would enter here. That's a 2 candle pullback. What if it was this one? You're going to enter when the candle closes below this one. You don't have to wait for it to close below this one or this one. The very first one that it takes out, if you're not sure, then wait for the second one. If you think, oh, this is a small candle, it was easy to take it out. Okay, fine. Then you enter the trade somewhere here, and guess what? Stop loss just above, and look at it. I mean, you cannot beat these guys. This is you getting a risk to reward of 1 to 3 to 4 to 5, so on and so forth. I mean, think of it. Think of it. I wish I had my trading view. I mean, maybe we'll check. Maybe we'll I mean, I wish we were on trading view, where we will bring out the position box and you can see it tells you by how much, what your risk to reward is. But guess what? We're entering here anyway. Think of that. I'm sure by here it's 1 to 1 to 1, 1 to 2, 1 to 3, 1 to 4. You got at least 1 to 4. Okay, that's assuming you didn't come out here. There are going to be times when the price is going down, it pushes up above the 10 moving average. It came back and closed here. So this was just you ignore it. You only come out when it closes. But then at this point, you're already moving, you're already moving you are trailing your stop anyway. You are trailing your stop. Give the market room to move, and you should be fine. All right. So I'll share one more thing with you, and one more thing with you, and then I'll leave it open for you to ask questions. So how about the entry? One, after there's a crossover, let the price begin to go down. If you are selling, let there be a takeout, a color switch. When there's a color switch, that's when you enter. The next time you enter is when a doji candle is also taken out. You entered here. The next candle was a doji candle. It pushed up. It was taken out again. So you enter. Because this green, which was taken out here. Another green taken out here. You enter again. So you're in two positions. You can also, obviously, another benefit, apart from the fact that it's a one candle stop loss, the second benefit is that you have, what's the word? There's no second guessing yourself because there are specific entry criteria. You always tend to have multiple opportunities to enter. So you entered one here when this green candle was taken out. When this green candle was taken out, you entered again. Guess what? The price pushed up. The price pushed up. And you entered again here. This price pushed up. And then two green candles, a doji candle. So you enter either when a green candle is taken out or when a doji candle. The doji could be either green or red, as long as it's a doji candle and it's taken out. On this occasion, this candle closed below it. I know it's just about, okay, maybe you could say, oh, okay, fine, it didn't quite close. It's basically closed just at the bottom. No, wait for it to, let it be obvious that it has closed below it. So since you were not too sure about this one, then enter when this one closes below it. So you're in three positions. Now, to be honest with you, even though there were more entry opportunities, you want to start getting wary because if the price has moved this much, you don't want to be taking more positions because it could then reverse against you. I mean, on this occasion, it did not, but at other times, it might. So you've taken three positions. Come on, you are fine. You don't want to be greedy. Greed can destroy your account. So one, a green candle was taken out. Second green candle taken out. On this occasion, a doji was taken out. And you got three positions. You are fine. Now, the next thing I want to say, the third major benefit, the first one is one candle stop loss, one or two candle stop loss. The second one is there's no second guessing yourself as to where to enter. You don't just enter arbitrarily. You enter when there's a color takeout, a doji takeout, or when there's an impulse move, a biggish candle. We're probably going to see that example soon. The third benefit is that you can afford, because you know it has a high win rate, you can afford to enter with a good size lot, a good lot size. You know, again, if you lose, you are losing just the one. Most of the time, it's going to be one candle. You know, if you lose, you're going to be losing one candle, 1.5 or 2 candles. So you can afford to enter with a big lot size. So I don't know about your different account sizes. The first one, obviously, you can enter with the biggest lot size. As you begin to go lower, start reducing your lot size. Don't start, because if the price, you entered this one here and it's now here, you're looking to enter, you could say, okay, fine, I will enter with a smaller lot size. if it goes and hit my stop loss because it's gone so far down, it's most likely going to start wanting to reverse. If it reverses, fine, it hits my small lot size position, whereas the big lot size has been there. Okay, so I'll pause now. Let me pause the recording and throw it open for questions and observations. Okay, so one of the questions basically is, taking when it comes to taking positions, when do we know when to stop, or how do we know when to stop? Like I was saying a while ago, there's been a crossover here. The moving average has crossed over. The price is now beginning to go down. You can see the moving average, descending. But really, even if you trade price action, or well, okay, fine, not no price action. Even if as a trader, okay, fine. If it's price action, and you're seeing the price oscillate like this, and you now see a big push to one side, it's usually a good opportunity to enter, especially as we have it as an engulfing candle here. Like I did say, yes, sometimes, if you are depending on your price action knowledge, you could decide to use price action. So fine, you could have entered here, even just with your price action knowledge. Otherwise, you can see the moving average going down. So the best time to be looking to enter is when the price is still quite close to the 200. The 200, as it were, is the one that is really telling us the overall direction. I mean, if the candles and the other faster moving averages are below it, it's telling us that it's going to be going down. So you want to be entering as close to the 200 as possible, but when it's gone too far away from the 200, I mean, by the time it's here, okay, fine. You can see by the time it gets there, by the time the price is here, it's kind of like far from the 200. Okay, but you're thinking to yourself, let's see how far this will go. Let's see how far this will go, because you are, I mean, if your first entry was here, your second entry here, by now, hopefully you are moving your stop loss. I mean, you have to be trailing your stop loss. You can't just, since you're not going for a fixed take profit, you have to be trailing your stop. So by the time the price gets here, maybe you should begin to think, I hope this has not gone too far, but your stop loss is now there somewhere anyway, so as to give the market room to move. How do you know whether to keep adding more positions or taking more positions? Again, if you are going for a fixed 1 to 2, 1 to 3, then okay, fine, I don't want to be adding by the time it gets here, or by the time it gets here. If, on the other hand, you are waiting, to trail it manually, whereby you want to see if the price goes and closes above the 8 moving average, then you can stay in the trade. You don't necessarily have to add any more to it because you've already taken, maybe by now you've taken 3 positions. Even if it's 2, just let it go with the 2 and, collect your profit. With time, I mean, with the experience, once you've traded this for some time, you will soon begin to know, whether to add more trades to it. I mean, let's try and zoom. Okay, because obviously, if you do understand or know price action, what else you would do is to be looking to target, swing lows. I mean, if you zoom out like this, you look to your left and check where the next swing low is. And you can tell because the price was going up here, the price itself and the moving average was going up, it has now turned, it's now going down. So it's most likely going to be looking to target next areas of liquidity, as in, what's it called? Swing lows. There was a swing low there. There was a swing low here, kind of. And And that's exactly where price came to target. So in that case, what you want to do, if you want to ascertain whether you want to enter or whether you are okay to enter more trades, this is where we're looking at. You know, if you want to know whether to enter more trades, what you want to do is wait for the 8 to cross over the 10 again, so for the 8 to cross above the 20 again. And when it goes back down, you enter. As long as it's crossing up and down, you can enter. Like here, okay, you can see here it was coming all the way down. It came quite close to it. It didn't cross over. I mean, when it started going down again, when you see a space between them, you know it's going to keep on, it's going to push down. I mean, when they are close to each other like that, it could just turn up and cross above it. But when they were like this and then it started opening up again, I call it fanning out. You know, it's fanned out. When the moving average is fanned out like this with a space, you know that it's most likely going to continue. If you're not sure whether to enter, then don't enter. If you have any doubts whether to enter, don't enter until you see the price, the moving average actually cross above it, you know, which is always a sign of correction. It crosses above it. And if it comes back down, oh my goodness, you know it's time to enter again. So you can see, again, small candles, you know, all kind of like oscillating in one place. Let's draw this. Small candles oscillating. Let's change the color. Let's use blue. Small candles just moving up and down in that space. I mean, this could be a box. This could be a box. Okay, let's do this since I tend to use. Let's do this. Okay, so you can basically just box this up. Like those of you who trade with me all the time, you know I tend to draw boxes. Is a box, is a range, and then boom, it pushed powerfully out of the box. It pushed powerfully out of the box with the moving averages, you know, arranged the way they should. And guess what? You can enter again. You can enter here. So if you think this is where, I mean, this is basically where we were. If you think the price has gone too far, don't enter. Wait for there to be a correction to the upside. You jump in again when it's continuing. You know, like I said, the price, the moving averages came up as though it was going to cross over. It didn't. Yes, the market could be deceptive. Okay, so I don't know. I hope that answered your question.
Yes, thanks.
Okay, so I suppose another way to know whether the price is still is in this case because it is dropping. Another way to know if the price is going to continue dropping or reversing would be you having to employ, you know, price action techniques. You know, because this is primarily is primarily an indicator-based technique. But if you really want to know, or another way to know whether you know you are still safe to enter uh, the trade, as in if it's going to continue dropping, then the price action technique would be to mark out your resistance zones. To mark out your resistance zones. I mean, for instance, okay, fine, it's dropping. It swings up a bit and continues dropping. This obviously then becomes like an area of resistance. Let's make it blue. You know, this then becomes, you know, I mean, a possible area of resistance, you know, and, you know, obviously it drops again, you know, forms, you know, well, the swing highs, we're looking at swing highs or areas of resistance. This obviously then becomes an area of a possible area of resistance. And then again, it keeps on dropping and forms, it swings high again, and obviously just keeps on going down. Now, the truth is, I know it's the case that if you are not sure what to do, whether to enter the trade again, and because of that you stay out, it means that you've ended up missing all this. You've ended up missing all this. That's why it is the case that I'm saying, when the moving average narrows like this, when the moving average narrows like this, because, okay, fine, like we did say, we entered here, we entered here. So we entered when this was taken out, let's just say we were bold enough to enter here again when this doji was taken out. I mean, this didn't quite take it out, but so we just joined this as one. So we enter at the close of this candle again. Now you are thinking to yourself, okay, fine, it seemed to have gone very far. Each time you are moving your stop loss, lower. This is the last entry. You moved it, there. You can decide to take the risk. If you're going to use the moving average as a guide, then that is basically what you're going to have to focus on, as in, has it crossed over? In this case, like I said, it did not cross over. Instead, it carried on down and even spaced out. It left a huge space, showing that it was going to enter again. It was going to keep on dropping. So what to basically do? Okay, fine. You will enter again. In this case, because it has opened up, you will enter again. It has dropped, taking out this low. If you want this low to be taken out, you enter again and you capture more. It's not a price action, price action strategy. So, it's not a price action. You're not going to be looking for price action, strategies, because otherwise this is a 15-minute time frame. If it was price action, it would be the case that you would have looked at the higher time frame, say maybe the 4-hour, so you know how far the price would possibly go. If you were trading price action, then you will start, obviously you will do a multi-time frame analysis whereby you look at a higher time frame. But because it's indicator based, you are basically just working with the time frame you are on. So like I did say, you can trade it on any time frame. So whether you are trading it on the 5 minutes, on the 15, or the 30, you are basically just working with that. You don't really need to refer to other time frames. Fine, if you want to be extra safe, so you know how much to capture, how much you can possibly capture with this, you can look at a higher time frame before coming to take your entry on a lower time frame. Okay, so I don't know if there are any more questions.
Yeah, thank you.
You're welcome. I mean, with that being said, nothing stops us from doing some multi-time frame analysis. So let's just look for a pair. I mean, can somebody call a pair? So it's not as though we are cherry picking. So can somebody call any pair or asset?
Pound JPY. No, Euro JPY.
Euro JPY. Okay. Okay. Euro JPY has, let's just say, let's go to the higher time frame. Okay. So this is the daily time frame. Friday, it did about 70 something pips. Okay. Okay. The reason why I'm hesitating with this is, obviously I would have wanted it to be a pair that is trending, so that I mean, obviously if it's, I mean, you can see on the daily, it is consolidating really. I mean, that's the high, this is the low, you know. Okay, fine. It's a 200 pip consolidation. I suppose, you know, if it is the case that you want to get out, you know, 30 out of it, 40 pips out of it, fine. Okay, so let's work with this anyway. So let's say on on Friday, we got to the chart on Friday. We didn't know whether price was going to be going up or down. I mean, we saw previous days it was going down, and then on Thursday it kind of like closed higher, leaving a week on both sides fine. So we got up on Friday morning, went to our computer, we saw this, you know, we're saying, okay, fine, we're not quite sure where the direction is. I mean, you know, it's been red, 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 but now it's closed as green. So we don't know. So let's just go to the 15 minutes. Let's just go to the 15 minutes. I mean, we can see this line, this white line here. That's, you know, it's a separation into days. So let's just go to the beginning of the day. This is run about the beginning of Asian session. You know, so by the time those of us in the UK wake up, maybe, you know, the price is around here. So we're saying, okay, fine. You know, what trade? What do we do? We can see here, you know, the crossover, the 8. Okay, I hear, you know, Peter basically obviously made the same mistake as I did. It's not the 10, it's the 8 moving average. So we see, you know, round about the London, the Asian session, there was a crossover here. The 8 crossed the 20 to the downside, but you had the 200. So, you know, it's not an established trend. You know, if the what's it called? If the 8 was there, the 20 there, and the 200, you'll be looking to buy. But on this occasion, it had crossed it to the downside. So we are thinking, okay, you know, the moving averages are not arranged in order, so we will do nothing until, you know, it's arranged in order. The 8 now crosses below the 200, and the 200, the 20 crosses below as well. So from here is where we want to be looking at looking at taking a trade. You know, because from here, you know, the moving averages are arranged the way we want. Okay, so after the crossover, I mean the 20 crossed, sorry, the 8 crossed the 20 there, everything crossed each other. The last one I needed to cross was the 20 crossing the what's it called? The 200. So that happened kind of like here. So we're saying, okay, fine, we can take trades anywhere here. Now, this green candle was taken out, not by this, but by this candle. So we say, okay, fine, we're entering that trade there. The stop loss, okay, I mean, with this one, that is the green candle that was taken out. You know, because what you really want to do, you can either use the one candle stop loss if the candle is big enough. If it's a power candle like this one, you can use one candle stop loss. Otherwise, if they are too small, then you want to use a 2 candle stop loss, including the green one that was taken out. But this one is fine. So what you do from here, let's measure it. From here to there is about 12 pips. Now, I know if you are scalping, you're going for a few pips. But to be honest with you, I rarely go for anything less than 15 pips. You know, so if it's 12 pips like this, you know, because the reason being that if the range of the candle, if your stop loss is a certain number, there's nothing to say really that you are going to be getting that range. So in this case, the stop loss is 12. Even though the strategy works, there's nothing to say that you're going to be getting the 12 to make you 1-to-1. However, you know when you do get it, it tends to give you more. So I am saying usually I would prefer a stop loss of 15, whereby I know I'm going to be going for 15 or more. Yes, that's just to make things clearer. I don't want to, the least I go for is 1-to-1. And if I'm going for 1-to-1, it would usually be the case that I take multiple entries at this entry, at this, entry. So it's not just a case of, oh, I take one entry here and wait for a color change again. I take another entry. If it's a small range like this, stop loss of about 12, I'm going to be taking three positions. I'm going to be opening three positions here at the same time. But we all have different risk aversion, so it depends on how you want to do it. But with this one, are we going to get 12? That was a stop loss. Well, we did. That was 13, 14. So we got a 1-to-1. That's the beauty of this. Most of the time, it will give you at least a 1-to-1. So we got a 1-to-1, and when we saw it begin to reverse, it could have taken us out. Where did we enter? We entered here. But then again, like I did say a while ago, that's why I was a bit hesitant when we were on the daily time frame, because if it's consolidating overall on the daily, I don't really want to be entering, because we saw, if you can remember, we saw, the price is really consolidating here, and it got wicks on both sides, which means indecision really. I would rather prefer if the price was going up like this. Even if it did have wicks, the wicks should be at the bottom, showing it's rejecting lower prices. But where we have a situation whereby, the price is now like this is all consolidation. I really don't want to be trading it. There are so many pairs in the market. There are over 26. I will move to the next pair. So this is basically me saying, yes, you can trade this strategy on any time frame and stick to that time frame. However, if you do want, to the odds to be in your favor, fine, look at a higher time frame. But having looked at a higher time frame like this, you don't want to be trading it if it's consolidating. So I would just choose another pair. Let me choose. Let me just choose GJ, or let me choose DAX. I know we love DAX in this group as well, don't we? We tend to love DAX. So let's look at DAX. Where is DAX? DAX, where are you? Okay. So, okay, fine. This is the 4-hour. We can see the price has been going down. I mean, again, it's got wicks, no problem, as long as the wicks are, on the upside. If we go to the daily, okay, daily is kind of like just coming out of consolidation, so that's fine. So let's now go to the 15-minute time frame. I would usually not trade other pairs on anything lower than the 15-minute time frame. It's only gold. It's mainly gold and maybe, I don't know, NASDAQ that I would trade on the 5-minute, but with other pairs, it's like 15. So with this pair, for instance, the NASDAQ, we can see this is the beginning of the day with this there. We can see the moving averages are already lined up the way we want it. They're fanned out the way the 200 there, the 20 there, and the 8. So we see here that the price was below, it went above. When it came down, that is when to enter. One, where is it? Where is it? Where is it? Okay, so the price went up. Let me make it smaller. The price went up when it came down below all three moving averages. That is another criteria, guys. Only sell when it's below, when the price is below all moving averages, and the moving averages are lined up the correct way. So it's taking out the green candle, and it's below all three candles. You buy, place a stop loss there, and then you are fine. So you can see it came down, it went up, did all that, came high, but it did not take you out, and boom, all the way down here. That is most likely about that's like maybe 1 to 1, 1 to 2, 1 to 3.5. That's 3.5 R. So that is awesome. Super trade.
That was a 3 a.m. trade. It's 3 a.m. or something.
This one, yeah.
Yeah.
Well, yeah. I
Maybe
mean,
choose a later one. Maybe 7 a.m. or
okay. I mean, obviously, those, because I do know some people who trade the Asian session. So obviously, if they are awake, this obviously confirms that yes, it does work in all sessions. But okay, fine. Let's look for around 7. So with this one, for instance, price is coming down, it starts going back up. Yes, fine. Wait for it to cross over. When it now comes down, below all three. Okay, fine. This is not quite proper, because you can see the 8 is still above the 20. So you want to wait for it to cross below. It did cross below here and started going down. So fine. When this candle, you are waiting for this candle to be taken out. I mean, fine. I mean, if you understand price action, I mean, some other strategy that we trade, Jacob. I don't want to go into it, but you can see that here. The HR. You could have entered here if you wanted to trade it. You could have entered here and taken it, to hit that point. That's price action. But if you were trading with this my pay packet strategy, you are waiting for this big candle to be taken out. And okay, so where was it taken out? It was taken out here. Again, it has to include the wick. It's not just the body, it's the body and the wick. It was taken out here, and guess what? Sorry, it closed here. It was taken out here, it moved down a bit, and then went. This would have hit your stop loss. This most likely would have hit your stop loss, just about, and the market came back down and closed here on Friday. Now, again, I'm sure you guys have heard me say we enter on a color takeover, color switch. We enter when the price takes out a doji, or we enter when there's a momentum candle. But there is such a thing as like double and triple momentum candle. This is really huge, because very well, you will know your account size. If you are to enter here, the stop loss is going to be at the other side. So you want to think to yourself, do I want to risk that much? I usually would not, risk it if it's so big like this. So depending on you, maybe the way you were thinking, you might either have taken this and ended up losing. That's a big loss, or you leave it out. Otherwise, if you have to take a trade like this, if you normally risk, 1% of your account per trade, don't risk a whole 1% here, because, the halfway mark is always the better place, to enter if it's a big candle like this. You don't want to be taking it here. You want it to pull back at least anywhere around the halfway mark is where you'll be looking to enter. But then you don't want to use your regular lot size. Just use a reduced lot size. Otherwise, again, there are many opportunities. If you have to let go of this one, just let go of it, and you'll be fine. Okay, guys, we are coming to the end of it now. So if you have any more questions or observations, you can let us know. Let's just go to the day before on NASDAQ. Okay, so I mean, let's see. Let's see. So this is the day before on Nasdaq. You know, price was going up and down. The 8 crossed to the upside, came down, crossed again, and then it crossed. That was where the cross happened. Where is that? The cross happened here, as in the 8 crossing the 20. Everything, the price is now below all candles. So you're thinking, okay, fine, I think I will get an opportunity here. This is a doji. The doji is taken out by this candle. You enter there, stop loss above there. I mean, well, you don't have to put stop loss above there. I mean, because obviously when the trend is established, you know, one candle stop is okay. But if you leave it there, that's fine. You know, you now think of it, that's the what's it called? The range of the stop loss. You definitely got more than your 1-to-1. Yep, you got like 1.5. So you can see again, for that day, you could have taken and won that trade. I mean, if you were going to take it at night, this is towards the end of the evening, the price came here, you know, you entered here, stop loss there, you know, overnight. Not everybody trades overnight, but if you are taking this trade, it came overnight and gave you a whole lot more than you could ask for. So anyway, that's basically, you know, the end of the session. You can see it's a simple, straightforward session, you know, and you know, I'll be adding you to the VIP Signal group, you know, Pete. Let me pause this now.
Yeah, thank you.